Hey, it's Anton Signals, and it's my business breakdown on what's happening across venture capital, tech companies and global corporations, unexpected deals, emerging trends and the signals shaping the American market. This is a briefing for people who make money in global business, which should our optics to the signals and look beyond the horizon. The Strait of Hormuz has been now effectively shut down for 3 months. And everyone understands what's going on to oil prices, but the bigger question: did anyone actually expect this to last this long? Honestly, I did, but for the wrong reason. I assumed that Iran simply outclassed that question. Historically, Iran is one of those countries capable of absorbing serious economic pain, sacrificing living standards, exception inflation, and politically consolidating around resistance to an outside enemy. So I expected a long standoff. Washington applying pressure, Tehran refusing to bend. But maybe there is another side to this story. Because while higher oil prices hurt consumers, they're turning into a massive opportunity for American energy sector. Since the strikes on Iran began on February 28th, US oil exports have surged to record levels, roughly 5.5 million barrels per day, more than a million above pre-war levels. In April alone, around 65 empty tankers arrived in the US to load American crude, nearly triple the normal pace. And LNG may be an even bigger story. Asian buyers that previously sourced gas through Europe are now increasingly locking in supply directly from the United States. Japan is already signing long-term agreements for American LNG. So this didn't happen overnight, because for years, the US invested heavily in fracking and horizontal drilling, unlocking shale reserves across Texas, Pennsylvania, and North Dakota. In less than a decade, America surpassed Australia and Qatar to become the world's largest LNG exporter. So the uncomfortable question here is whether the Hormuz crisis became an incredibly effective customer acquisition strategy for American energy. And investors are already betting on it. Exxon, Chevron all rallied sharply, but some of the biggest moves happened deeper in the LNG ecosystem. So Goldman Sachs recently highlighted Junior Energy, Venture Global, and Golar LNG. So Golar is especially interesting because instead of building giant LNG plants onshore, it focuses on forwarding LNG, factory ships that can liquefy gas directly at sea and load it onto tankers. Another company worth watching is Accelerate Energy, which does the reverse, so converting LNG back into usable natural gas for countries that don't want to spend years building massive import terminals. So if you believe geopolitical instability is here to stay, if you think choke points like Hormuz will remain vulnerable, and if you think AI infrastructure will continue driving massive energy demand, this sector starts looking very attractive. Because the real AI boom may end up being not just about chips and software, but about energy. Story 2. Bitback is now spending almost all its profits trying not to lose in the AI race. Look at this. The combined free cash flow of Amazon, Alphabet, Microsoft, and Meta is collapsing. In Q3, is expected to fall to just $4 billion, more than 10 times lower than during the pandemic peak years. Together, these companies are spending around $725 billion on AI infrastructure, and that's a major shift. For years, big tech operated like money printing machine. Huge margins, predictable profits, mineral capex. Now they are turning into some of the largest infrastructure investors on earth. It also looks like they only now realize the AI threat is real. For years, companies like OpenAI and Anthropic looked like interested experiments, but now that all giants understand that AI could eventually upend their core business. Alphabet is slowing buybacks for the first time in years. Meta issued debt. Amazon is spending so aggressively may help prohibitability. And what's interesting is that big tech seems to understand that they already lost their first phase of the AI race, the animation phase. Startups moved faster, so the incumbents are shifting the battle to infrastructure where startups simply cannot compete. Microsoft has tripled the value of servers and networking equipment on its balance sheet. Amazon plans to spend nearly $200 billion on infrastructure this year alone. Meta is building data centers the size of small cities. At this point, big tech looks less like software companies and more like telecom giants during the internet build-out. And suddenly companies the market had almost written off are becoming relevant again. Take Cisco. Their data centers require enormous networking capacity between hundreds of thousands of GPUs. That means switch, routers and interconnects matter again. Cisco's AI orders exploded and the stock is up roughly 80% from its lows. IBM is another interesting example. Nobody thinks Watson competes with ChatGPT. You probably never heard about Watson, neither did I. But large companies don't just need AI models. They need AI-integrated safety into decades-old enterprise infrastructure. For example, banks, insurance companies, governments, they cannot just simply upload sensitive data into public AI system. They need security, compliance, internal deployment, and systems. And that's exactly where IBM has spent decades building expertise. So maybe the market is underestimating parts of legacy big tech. Because building a successful AI product isn't just about hardware innovation, it's also a lot of infrastructure, workflows, integrations, and decades of accumulated user experience. And that may end up being the old giant's biggest advantage in the AI era. Story 3. OpenAI shut down Sora 2. Consumers got bored with AI VR generation and now the real money is moving into professional production. Sora was the video generator that exploded across social media about a year and a half ago. The AI made glimpses of cinematic cats, surreal worlds, vegetable acting-like humans. It completely took over the internet for a while. According to industry estimates, Sora was running roughly 15 million a day in compute costs. Total lifetime revenue around 2 million. That's a catastrophic business model. Tens of millions spent so people could generate short viral clips. And the major question here is whether this was simply OpenAI falling to monetize one product, or whether the broader narrative around AI replacing content production is starting to break down, because the market itself is still growing. Runway raised funding at a roughly $4 billion valuation. China's Kling reportedly reached hundreds of millions in analyzed revenue. Google Video continues expanded, so the editor is not bad. But look close at who is actually succeeded. Runway isn't a consumer toy, it's built for filmmakers, studios, and professional editors. Kling is increasingly focused on advertising and enterprise workflows. Video is being integrated into Google's broader ecosystem. Meanwhile, consumer-first AI video apps like Sora, Pika, and Luma are losing momentum fast. Downloads and engagement reportedly collapsed from their peaks, and that completely changes the original AI video thesis. For years, the story was that AI would democratize production. Everyone would become a creator, Hollywood-level tools in every smartphone, but reality may be turning out to be the opposite. Most consumers simply don't want to create content professionally. They experience with AI tools for a week, post some clips, and then move on. The service adoption and serious revenue is happening inside professional workflows and enterprise infrastructures. And honestly, this pattern keeps repeating across the AI. First comes hype and mass downloads, then consumers lose interest. Then AI quietly moved to B2B, where companies actually pay for productivity gains. We saw it with the image generation, we're now seeing it with AI coding tools too. Online developers talk about replacing entire engineering teams with AI copilots. But in reality, most non-technical users still cannot meaningfully use advanced code models. They open the app, try something, get distracted by TikTok, and close it. So the broad takeaway is uncomfortable for part of the venture market. Consumer AI apps may be actually one of the riskiest bets in tech giant right now. Meanwhile, the companies building professional tools for editors, marketers, lawyers, researchers, and enterprise are quietly building sustainable business with their real revenue. And that means that next time you see an AI startup celebrating 100 million users in a week, it may not be mystery advice, you know. It may actually be a warning sign. Story 4. Elon Musk versus Sam Altman. A little battle that increasingly looks less like a lawsuit and more like a war between two giants egos fighting over the future of AI. Because guys, what truly drives urinary finders? It's hardly the money. It's influence, followers, cultural brevity. And I think Musk understands something very clearly. OpenAI became the defining AI brand of this era without him. That's the real wound here. If you look at social media over the past few months, especially under interviews with Sam Altman, there's been a massive wave of hostility. Much of it comes from Musk's audience accusing Altman of betraying OpenAI's original mission by transforming it from a non-profit into a commercial empire. Formerly, Musk is suing OpenAI and Altman over the company's restructuring, demanding leadership changes and enormous financial damages. Altman's position is essentially you didn't invest in OpenAI as an equity shareholder, you donated to a non-profit and even received tax advantage for it. But the real story goes much deeper. Back in 2015, long before ChatGPT, Musk, Altman and several other Silicon Valley figures launched OpenAI, a non-profit dedicated to developing artificial intelligence openly and safely. But as AI capabilities advanced, the stakes became enormous. The key question shifted from building AI to controlling AI, and reportedly, tensions inside OpenAI grew when Musk wanted more influence over the company's direction. It's interesting that it touches a very old one for Musk. Back at PayPal in 2000, Musk was removed as CEO while on his honeymoon after internal conflicts with the board and other executives, including Peter Thiel. He knew it as a betrayal and spent years making sure he would never lose control again. At past Times 56, he built systems where he remained the unquestioned center of reality. And OpenAI repeated the same drama on a much larger scale. The team effectively chose to move forward without him. And after Musk left, OpenAI launched ChatGPT and became arguably the most important AI company in the world. Massive revenue growth, Microsoft partnership, valuation approaching the freedom dollar conversation. For someone used to being the central figure of every major technological revolution, being excluded from the defining platform of the AI era is probably deeply personal. That's why this lawsuit no longer feels purely financial. It looks increasingly like an attempt to rewrite the history and reconnect Musk's identity to the rise of modern AI. And you can see that frustration everywhere. First the tweets, then XAI and Grok, and now escalating legal battles. At one point, Altman reportedly even reached out privately, telling Musk that the public attacks generally hurt him and acknowledging that OpenAI probably would not exist without Musk's involvement. But by then, the relationship already seemed beyond a pair. Because this conflict isn't really about money anymore. It's about who gets remembered as the defining prophet of the AI age.